Clifford Bennett, Herston Economics. Another day in a grand bull market. What can we say? The US market continues to make steady gains. They're looking for better mergers and acquisitions activity over the next year. It's certainly going to be the case. I think boards of directors in the United States right now are starting to just get the idea that it is a grand bull market, that the rest of the world took off a year ago and they better hurry up and catch up. So you're going to see massive reinvestment from US corporations. You're going to see a lot more activity over the first half of this year as they lift their game and they go from playing defense, which they were all the way up to the Christmas break. They've got to change their game from playing defense to attack, and that'll mean more debt issuance, using their cash reserves, but certainly making very aggressive investment and business decisions, far more so than we've seen for a few years out of the United States, which the rest of the world's already been doing. Well, the rest of the world that matters, Asia and Latin America. So we're going to see that start to happen with European firms as well. There was a bit of an article in today's Sydney Morning Herald from the chief economist of some bank saying that, watch out for a commodity price crash because it's got to happen, because it always happens. And, that will mean the Reserve Bank will aggressively cut interest rates. Some logic along those lines, but seriously, what a load of nonsense. Can we please get past these people who keep trying to sell fear into our market, who keep trying to hold individual investors back from investing and participating what is going to be the world's most exciting economic expansion, most exciting bull market perhaps the world has ever seen, let alone our generation or the generation before. I noticed oil's dipping a little bit. Oil could dip to 85, 84, maybe 83, but certainly any lower than that, towards 80. Buy as much oil as you can, put it in your garage for your grandchildren, because oil is going to 145. And this pullback in oil because Egypt's going to calm down, it's quite silly. The market's had a really good rally from 78 to 92. It's having a bit of a pullback now. I still think this is a consolidation pattern that will eventually break higher. May consolidate here for a while, but I do think there's still limited downside. Gold's looking fantastic today. I'm almost thinking like just throw aside any caution and just buy gold. Australian dollar, very comfortable now. 101.50 area. Everyone thought it didn't belong above parity. We've been telling you it's going to 103 short term, 108 this year, 112 next year. No change to that. Euros a buy as well. Generally speaking, currencies still have to appreciate a lot. Most currencies against the declining US dollar this year. Bernanke said that he's going to stick to the quantitative easing, buying more bonds. Sounds more like bonds for boys than having any real fundamental basis, but there you go. And that will continue to add to what is already a weakening US dollar in any case. When we come to back to interest rates, those central banks, let's face it, the Fed and the ECB, they can't raise rates for the rest of this year, really because of unemployment levels, around 20% in Spain, still at 9% in the US. You're going to have a strong economic boom with modest inflation for reasons I've discussed before, but interest rates are going to stay low whether the central banks are enlightened or not because of high unemployment. So strong growth, bull markets, low interest rates, means blue skies for equities. Our market's going to continue to accelerate a lot higher. So very bullish across the board still on all of those fronts. Have a good day.